I need you to explain to our listeners and viewers why it's the Fed's job to move the unemployment rate, as you state, up above 4%.
Well, the labor market is the tightest basically it's ever been, and you can see that by the ratio of unfilled jobs relative to the number of people that are unemployed. That ratio is 1.9 to 1. In February 2020, it was 1.2 to 1. So we have a labor market that's unprecedentedly tight. The Fed needs to loosen that up, or wage pressures will accumulate, and that will keep inflation above the Fed's 2% inflation objective. The problem the Fed has is that in the past, it's been very, very difficult to push the unemployment rate up meaningfully without precipitating a hard landing. That's what the Fed's going to try to do this time, but it's extremely difficult to do. And they haven't really been as forthcoming, I think, in their forecasts as they need to be, because if you look at their last summary of economic projections, for example, the disinflation occurred almost immaculately. The Fed didn't really tighten very much. The unemployment rate didn't rise. Yet inflation came back to the Fed's 2% target, and it really begged the question of what caused inflation to come down. I think the way you get inflation down is you need more slack in the U.S. labor market. That's not a friendly message from the Fed, but that's what's necessary at this point.
And Bill, just to put some numbers on that, as you say, core PCE year end for the Fed 22, 4.1%, 23, 2.6, and unemployment 3.5, and then 3.5 again. And many people have been asking the same question. Bill, you know the chatter right now is this conversation about a pause in September. How are you interpreting some of that conversation?
I wouldn't put too much stock on it. I think what's happening is the Fed's pretty convinced that they need to go to something close to neutral, and expeditiously is the way that they put it, and so that's what they're doing. The notion that at some point they're going to take a pause and look around, of course that's going to happen at some point, but it's going to be driven by the economic data. I think that the economy is going to have enough momentum to keep the Fed, so the Fed will keep going into the fall. The market's priced to a peak in the federal funds rate of 3%. I think we're going to get to there pretty easily, and the Fed will probably actually have to push beyond that ultimately.
Bill, what kind of unemployment rate are you looking for to indicate perhaps a tightening, a loosening in the very, very tight labor market?
Well, the Fed's own forecast is that a neutral unemployment rate consistent with 2% inflation is 4%. So I think you need to get the unemployment rate up to at least 4%. The fact that we have so many unfilled jobs suggests that maybe the unemployment rate consistent with 2% inflation is even higher than 4%. So I think we need to at least get to 4%, and that's the problem. It's difficult to do that without precipitating a full-blown recession.
Bill, did you take any message from the fact that President Biden met with Fed Chair Jay Powell yesterday, that there was this focus on the Fed being the main driver for what happens with inflation going forward and the politicization of the Federal Reserve?
Well, I think Biden was actually not politicizing the Fed. He was basically saying the Fed's job is to control inflation, and I'm not going to challenge the independence of the Fed to do that. In some ways, though, he's putting the burden now on the Federal Reserve rather than on the administration. I viewed it as a political event, not an economic event. I don't think it changes what the Federal Reserve is going to do or what the Biden administration is going to do.
Bill, we had a one-off medical event, a pandemic of our lifetime. That got us out to 14.7% unemployment. Can we cut any central bank slack and have them extend out the x-axis and just take longer to get this done, to repair off of this medical event?
Well, if they take longer, the risk will be that inflation will stay higher, and then that will start to get embedded in higher inflation expectations, which will make their job more difficult. The good news for the Fed right now is they're highly credible. Market participants expect the Fed will do the job and get inflation back down. Inflation expectations at the longer-term horizons are still very well anchored. If the Fed dawdles, then the risk is that inflation expectations become less well anchored, which will make it harder for the Fed to get inflation back down.
Bill, is your view hardening, not softening, based on incoming data that this Fed funds might end up with a 4 handle and maybe not a 3?
I don't think it's changed too much. I mean, the good news is the Fed has things in hand today in terms of market confidence, in terms of inflation expectations being well anchored. That's the good news. The bad news is I think people are understating how difficult this job is.
What do you make of this idea that they can target job openings, Bill? JOLTS data, which is a little bit dated. What do you make of that?
Well, I think their story is a quite an optimistic one, that they can tighten monetary policy sufficiently to reduce the demand for labor without actually pushing up the unemployment rate meaningfully. This is the tightest labor market I think we've ever had, frankly. And it seems to me if the labor market is tighter than it's ever been before, that makes the job more difficult, not easier.